What makes some trading instruments more popular than others? Why do certain currency pairs have tighter spreads while others are more volatile and expensive to trade? And why is Euro USD called the king of currency pairs? In this video we are going to break down the main CFD pairs that you can trade, including Forex pairs, share CFDs, stock indices, commodities and cryptocurrencies. By the end of this video you will understand what these instruments are, how they work and how each category is different. So let's get going. Let's start with currency pairs. In Forex trading you always see currency pairs. More exact, the value of one currency compared to that other currency in the pair. Each pair consists of one base currency and one quote currency. So when you buy a currency pair, you are actually buying the base currency and selling the quote currency at the same time. When you sell a pair, you sell the base currency and you buy the quote currency. Forex pairs are usually divided into three main categories. You have major pairs, minor pairs, and exotic pairs. Major currency pairs are the most traded pairs in the Forex market. They usually have high volatility and tight spreads, which makes trading them more popular for most traders. Some of the most common major currency pairs are Euro USD, USD JPY, GBP USD, USD CHF, AUD USD, and USD CAD. The most commonly traded major currency pair is Euro USD, which represents the value of euro compared to US dollars. Let's say for example that Euro USD has an ask price of 1.10240 and a bid price of 1.10220. So you can basically buy 1 euro for the ask price and sell 1 euro for the bid price. As buyers and sellers constantly interact in the market, these prices continuously change. Another interesting point about major currency pairs is that AUD USD and USD CAD are often called commodity currency pairs. This is because Australia and Canada are both rich in natural resources, so even their currencies can be influenced by changes in commodity prices. What makes the major pairs more special is their liquidity. Liquidity simply means how easily the market can handle the buying and the selling without causing large price shifts. So the more buyers and sellers there are in the market, the easier it is to enter and exit trades at fair prices. Next on are minor currency pairs, and these are all the pairs that do not include the US dollar. They still involve major currencies, but they are usually slightly less liquid than major pairs, and thus even their spreads can be wider. Examples include Euro GBP, Euro JPY, and Euro CHF. These pairs can still offer strong trading opportunities, but they move differently compared to the major pairs because they are not directly connected to the US dollar. Last on the list are exotic pairs, and this includes pairs that have one major currency and one currency from a developing or emerging state. Examples include the USD ZAR, the USD RUB, or the USD ILS. These pairs are usually way less liquid and have wider spreads, which means that they can be more expensive and riskier to trade. But at the same time, exotic pairs can offer high volatility and diversification. However, they do require a deeper understanding behind the economies of the states where those currencies come from, as well as a tighter and stricter risk management plan. Now let's move on to share CFDs. You've probably heard of trading shares like Apple, Tesla, Meta or Amazon. When you buy actual shares, you're buying parts of that company, which also gives you voting rights. With share CFDs, that works differently, because you're not buying actual shares. Instead, you are trading the price difference from the moment that you entered your position and close your position. So you don't own parts of the company and you don't receive any voting rights. You're just speculating on the price movement. Share CFDs are usually traded in the currency where the company is based in. For example, if the share CFD is based on the company that is on the NASDAQ 100 list, then it will usually be traded in US dollars. Next, we have stock indices. A stock index tracks the performance of a group of companies and gives traders a broader view of the market. Some popular examples include the S&P 500, NASDAQ, Australian 200, the Dow Jones US 30, and the FTSE 100. So the index CFDs track the price movement of their respective stock index. For example, the Australian 200 CFD tracks the movement of the Australian 200 index, which represents 200 of the largest companies listed on the Australian Securities Exchange. This one is traded in Australian dollars. On the other hand, the NASDAQ index is known for being heavily concentrated on technology companies, including major companies like Apple or Microsoft. The FTSE 100, also called the FTSE, tracks 100 of the largest companies listed on the London Stock Exchange. Now let's talk about commodities. Commodities are raw materials or resources that are grown, produced, or extracted from the earth. So in CFD trading, commodities are usually categorized into three major groups: energy commodities, agricultural commodities, and metal commodities. Commodities include UK oil and US oil. UK oil is based on Brent crude oil, and US oil follows WTI crude oil. And these are very important global benchmarks for energy prices. Agricultural commodities include raw goods such as sugar, cotton, coffee beans, and similar products. Metal commodities include gold, silver, copper, and platinum. And gold is one of the most popular commodities in trading. It is often called a safe haven because there is a limited amount of supply. It is seen as a store of value and is often used as protection during inflation or uncertain market conditions. Silver and other metals are also very popular, especially because they move differently compared to stocks and bonds in times of crisis. Oil is another major commodity. Often called as black gold, it is used in energy production, transportation, plastics, and many other industries. The oil market can also be very volatile, which makes oil exactly very popular for traders who want to speculate on price movements. And finally on the list, let's talk about cryptocurrency CFDs. Similarly to what we've heard before today, cryptocurrency CFDs allow traders to speculate on the price movement of cryptocurrency pairs. And this one without needing to use any digital wallets or crypto exchange directly. Many cryptocurrencies are quoted against some major currency, most often the US dollar or the euro. Some of the most traded crypto CFDs include Bitcoin, Ethereum, or Litecoin against the US dollar. So how does trading a crypto CFD practically look like? Let's say Bitcoin has currently recovered from a dip, but you don't believe that this rally will continue. So now the value of Bitcoin USD is at 64,500 and you decide to open a short position believing that the price will dip until 63,000. To manage your risk, you place your stop loss at 65,200. Let's say in the first scenario Bitcoin dipped at 63,000. So in this case, from your starting position, you will be in $1,500 of profit. Let's say in the second scenario Bitcoin doesn't dip, but it moves against you and continues to rise. Let's even say that it rose so high that it didn't kick you out of your stop loss at 65,200, but it went up to 65,490. In this case, you would have made a $990 loss. This example is just to show you that CFD markets can help you benefit from both rising and falling markets, but that controlling your risk is essential in trading. So to summarize, CFDs give you options to trade in different markets. Each of those markets having their own set of characteristics, whether it be in liquidity, volatility, or trading conditions. Understanding these differences is important for you to pick the right instrument to trade with. If you found this video helpful, give it a thumbs up, share it with your trading friends, and hit the subscribe button so you never miss another educational episode from our side. Also, we're happy to answer any of your questions in the comment section. Thanks for watching, and I'll see you in the next one.
Hola Prime, trade with transparency.